Mortgage rates continuing to fall. The average 30-year fixed sliding to 6.09% from 6.13%. That's according to Freddie Mac. Now, mortgage rates do not move directly with the Fed's interest rates, but more in line with the 10-year. But certainly notable that Jerome Powell indicated Wednesday, quote, "Given our outlook, I don't see us cutting rates this year." Mike Fratantoni is the Mortgage Bankers Association Chief Economist. He joins us now. Good to see you, sir. So that rate, I think a pretty notable move down near that 5 range. But given what the Fed chair said, how low do you think rates will get this year?
And so we're forecasting that we're going to be closer to 5% than 6% by the end of 2023. As you noted, the Fed, we think, still going to push up short-term rates at least one more time, one more 25 basis point hike. But long-term rates like 10-year treasuries, 30-year mortgages, already reflecting the weakness we've seen in the economy and honestly reflecting the fact that at some point the Fed will reverse course and begin to drop rates.
How low do you think rates need to drop in order to spur a lot more activity in the housing market? Because still, even though we have seen some improvement, we know sellers and a number of buyers still remain on the sideline.
Yeah, it's been interesting. You know, fourth quarter of 2022, the housing market, I think, was just dead in the water. And you look at the level of activity right now, it's still very low. You know, applications to buy a home still about 40% below where we were last year at this time. But we're beginning to see an increase in the level of activity, and that's in our data in terms of mortgage applications. It's in pending home sales from the realtors, and it's in builder sentiment from the home builders. So everything pointing in the same direction. The January a little bit better than that extraordinarily slow fourth quarter from last year.
Is the worst behind us, Mike? Excuse me.
Yeah, I mean, we were above 7% for a 30-year mortgage rate in fourth quarter last year. And now, like you said, you know, last week we were a little above 6. And some of the data in the market today say a lot of mortgage lenders are quoting rates that begin with a 5. So I think that's going to be enough to get potential buyers much more interested now looking for properties.
Mike, what about the state of the economy right now? Because that remains uncertain. If we do see a recession, how do you see that impacting housing over the next several months?
Yeah, that is our baseline forecast. So we think we're going to be in a recession the first half of this year. The unemployment rate, which was at 3.5% in December, we see getting above 5% by the end of 2023. And that's going to be a headwind, certainly. But a benefit, again, particularly for that first-time buyer, is rates down from 7 to maybe the mid-5s. Home prices, instead of growing double digits, we think are essentially going to be flat for much of the next 2 years. So from particularly a first-time home buyer perspective, the market's a bit more inviting. They might actually see some additional properties out on the market, particularly in the new home portion of the market. We've seen inventory pick up. In terms of existing homes, inventory is actually still quite tight. And a lot of current owners, if they don't have to sell into this somewhat weaker market, they may just hold on to their properties for a bit longer.
Historically speaking, where are those inventory levels, and when do you believe that story begins to change?
Yeah. So again, different on the new versus existing side. New home side, there's about 9 months of supply. A lot of that are homes under construction, and we expect that builders are going to be forward-leaning in terms of, you know, offering incentives and in some cases price cuts to move those homes. But a builder's in a different position from a current owner. Homeowners in the U.S. in the aggregate have about $30 trillion of home equity right now, and millions of them are sitting on mortgages that were taken out at all-time lows, 3% or even lower. So we have less than 3 months of supply on the existing side. So if you're a buyer, probably more opportunities to see in the new home market than the existing home market right now. You know, 6 months of supply is typically what you think as a balanced market. Again, new home market looks like we got more than that, existing a lot less.
Mike, you mentioned the fact that some buyers are coming back into the market. How much leverage do buyers have today?
Well, certainly a lot more than they did last year at this time. Last year it was all about, you know, multiple bidding wars and properties going for well above list price. You know, now it's just not the same level of fever in the market. So, you know, I think a buyer has a lot more leverage. I wouldn't overstate that, though. Again, given the lack of inventory on the existing side, if a current owner is not in any way distressed and doesn't have to move, you know, they may not give a lot on price, but there may be other options available. You know, you see many sellers perhaps they're going to offer to buy down that buyer's mortgage rate for a period of time. That certainly happens in the new home market. So it's not all about price and negotiating around price. There are other terms of the transaction where a seller might be more flexible to get the property sold.
Mike Fratantoni, Mortgage Banking Association Chief Economist, thanks so much.